led by ACC seeing traction. Jaspreet Singh Arora, who's head of research institutional equity, Systematix shares and stocks, joins in with a quick review. Now, ACC's numbers looked good. How sustainable are these numbers?
Hi, good morning and thanks for having me. So they look largely sustainable. Obviously, the only concern here is the rising cost of inputs, and there's in particular it's been diesel and crude-related petcoke prices. And to the extent that the companies would be able to pass it on, these looks pretty. So I don't think there should be a deviation beyond 5-6% on an EBITDA per ton perspective for the balance part of the year.
Why is there such a big disparity between Ultratech and ACC numbers?
Okay, good question. There are a couple of factors which have held true for ACC. So one, the retail mix is higher for them. Second is they have not really chased volume growth, which was the case with some of the other leaders. And third, over a period of time, the cost pressures that were there in a company like ACC that have also reduced over a period of time. So to the extent, what I essentially mean is if there was a $250 cost push per ton, that was nullified by a price hike, negating much of that. So I think it's a mix of multiple factors, also including the utilization, which in the case of ACC was closer to 84-85%, while in Ultratech it was 75%, and therefore one takes a call whether to go for volumes or for price.
Jaspreet, but if you look at the ACC commentary, they've said that 2018 and the latter part, they see demand being positive, but cost pressures are going to sustain. We all know that RMC costs are really being, piling up for cement as a sector. What do you think the pricing strategy is going to be? Can we see a significant price hike come by from cement majors? Or do you think because demand is so strong, they'll be able to match up to the volume growth as it is?
See, I don't think pricing will be too strong for the balance part of the year because, I mean, there is not too much, synchronization as we speak in terms of the strategy with regards to some of the larger and mid-sized cement companies are adopting to, and which happens in a region where there are too many smaller players and also a period where the volume growth suddenly jumps up from 5-6% to 8-9% or maybe 9-10%. But I think I just want to highlight the fact that the volume growth rush that we are seeing seems only temporary because it's only been in the last 1 quarter or maybe 4 to 5 months, and that was also because of a low base effect of last year. I think once we move closer to post-November, I think the high base effect will start playing out against this thing, and in fact the number could be in terms of low single digits. So year as a whole, I don't think we will do anything beyond 6-7% for the current financial year ending March 19.
What we're seeing today, given that there was under ownership in cement, there were a whole lot of shots as well piled up in the sector. And, fairly enough, you're seeing that big short covering led bout take the entire group of stocks up. Would you buy into the stocks then, considering you feel that this volume bump up is at best temporary, or the cement continue to be an avoid for you?
I wouldn't say buy or an avoid. I think more on the neutral side, but it's going to be stock specific. I think the sector is according to me, at best expected to be a market performer, and I think 2 or 3 stocks is what we would like to stick to and not buy every second stock or not look at every second stock there. So I think from a larger ones, definitely ACC is one name which looks interesting, and moving on, I think after that Shree, Dalmia are some of the other names which other good names that one can look at. But I think it's going to be stock specific and not that the sector is getting re-rated or will definitely outperform over the next 1 year. That is not something that we believe in.
Jaspreet, thanks very much for joining us and